SIP or lump sum, which is better? There are some things that will always be confusing and you just can't figure it out. And one thing that most people are confused about is the best way to invest. Should you invest systematically or in lump sums for you to get higher returns? Faced that question already? Okay, here's a perspective. Let's assume that both your neighbor and you want to grow flowers in your respective gardens over a period of 1 year. You both go to the market together, but while you buy all your seeds and plant them at one shot, he decides to buy and plant only a few every month. And the price of the seeds remains constant throughout the year. So which of your gardens is more likely to be full of flowers by the end of the year?
Well, obviously, the garden that gave all the seeds a full year to grow and bloom will be the clear winner here. But how about a more practical scenario for this theory?
Okay, here's one. Say you invest a lump sum amount in your savings bank account of Rs 1,20,000 on December 31st. On the other hand, your wife invests Rs 30,000 every quarter. Now you both start investing in a bank deposit on January 1st, but while you invest in a fixed deposit, your wife invests in a recurring deposit maturing in exactly 1 year. In both cases, the interest is compounded quarterly. Well, although you both invested the same amount after 1 year, you will have accumulated a larger sum than your wife. This is simply because while your entire amount was invested for the entire year, your wife had 30,000 invested for the year, 30,000 for 9 months, 30,000 for 6 months, and 30,000 for only 3 months. So the average period of investment really is quite short, earning her less interest than you.
You see, even if the wife had been able to negotiate a higher rate of 9% per annum, her accumulation would not catch up. Even at 10% and 11%, she wouldn't be on par. It's only at the rate of 12.78% that the accumulated sums would be equal. That's a huge difference for her to make up. This says a lot about giving investments time to grow, doesn't it?
Hold on though, there's always two sides to a coin. Back to your garden. Let's imagine that the prices of the seeds fell every month starting from month 2 and continue to fall right up to the end of the year. Since your neighbor bought seeds over the same value every month, as the price fell, he got more seeds from the same price from the market. He now has way more seeds to plant every month.
Whoa! Now, which garden is likely to look more full at the end of the year?
Yes, exactly. Now imagine you opted to invest your principal in an equity mutual fund at an NAV of Rs 20, therefore giving you 6,000 units. Your wife then also invests in the same scheme, receiving 1,500 units on Jan 1st. On April 1st, the NAV was Rs 18, giving her 1,666.67 units, Rs 15 on July 1st, giving her 2,000 units, and Rs 17 on October 1st, giving her 1,764.71 units. Now fast forward to December 31st when you get your account statements at an NAV of Rs 22. The value of your investments has now grown to Rs 1,32,000 in 1 year. That's a 10% return. But hold on, your wife who invested in the same scheme as you now has a much larger amount, but you invested for much longer though, so how did this happen? Simple. At 3 different points during the investment period, your wife managed to invest at a lower NAV than you did at the beginning of the year, thus benefiting from a lower average cost. Over the year, your wife managed to buy 6,931.37 units versus the 6,000 units you bought at the beginning of the year. Also, your price of buying each unit was Rs 20, whereas her average cost over the 1 year was Rs 17.31. This concept is called rupee cost averaging. Make sense?
And this is just one side of the story. In the previous example, the NAV kept falling through the investment period. But what if the NAV were to rise? The story would be very different, wouldn't it? As a lump sum investor at the beginning, these investments would have done much better.
There's even a third angle to this story. What if you withdrew all your investments on October 1st? You would have received a higher NAV than on December 31st. Thus, the value of your investment would be Rs 1,80,000 as against Rs 1,68,000.
It's not easy deciding which is better, is it? Lump sum strategies work if an investor manages to invest when the markets are constantly rising. Systematic strategies, on the other hand, work better when prices are going down, with opportunities to invest at lower levels. The deciding factor between the two will be the frequency of investments and when you withdraw your investments.
As for choosing between SIP and lump sum, don't be stressed. You know the difference now and you know the benefits of each. There's no right answer. Just think about your situation and your objectives before you decide whether to plant all your seeds at one go or little at a time. Either way, you'll potentially have a garden full of flowers. We hope you've enjoyed watching this video. Watch more and we'll help you learn about different investing concepts.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.